Welcome to the Beyond the Numbers podcast. Before we dive into this episode, we want to share an important disclaimer regarding the content of our discussions.
Welcome to the latest Beyond the Numbers podcast, which is a Live Smart podcast. This one is going to be slightly different in that this podcast really is for ARM employees. The reason for that is that we've dealt with a few clients who are ARM employees, and we've seen a couple of trends and some patterns. So we thought we'd put this podcast together as a bit of an information guide based on what we've seen. So over to you, Julian.
So yeah, obviously I've got a few people at the minute that work at ARM, and we're seeing a definite pattern in, and it's across really, I would say, their pension, their share package that a number of them get with as part of the wage, really. And we're seeing issues around capital gains. We're seeing issues around the pension fund choice, maybe not giving them the growth they should have. And then to add to that, we've become aware that they're about to shut down their legal and general workplace scheme in favour of another scheme that I've not seen the details of yet. But obviously, this triggers a bit of an advice need, straight issue, I would say. And I think ultimately that potentially could lead to better outcomes on tax and investment performance. Do you want to start with the investment performance part when we address that, or shall we go straight into the tax parts?
Let's go with the tax parts just to lay the table a little bit. I mean, what you've said there basically is all of it is that there's a few moving parts that would trigger a review, really.
There's a lot. I think what it really reinforces is what we've said on other podcasts, which is sometimes people don't realise they need the advice until they start having it. And we're now seeing it with this handful of people that we've got in the back office at the minute to do research on all different situations. One's coming up to retirement, one's trying to repay his mortgage, ready to think about retirement and plan ahead using tax relief, and the other one is moving to Australia. So he's got to look at his options as to whether he leaves his pension here, moves it, the tax implications. So we've got three almost examples as different as you can even think about, really. But every example yields quite a lot of good information. So should we start with the Australian scenario?
Yeah.
Because I know a lot of ARM staff do move around, because
Mm.
obviously a lot of them, there's a number of them that are in Cambridge from other countries, and so obviously some of them are going back to where they came from, and then others are just looking for opportunity because of what they do in AI
Yeah.
out of the UK, because there's obviously international opportunities, particularly in the States, but some are just looking for an easier life or something, a bit more balanced.
Yeah.
Um, but yeah, in the Australian scenario, we've had to involve an Australian advisor, and we've taken advice to try and work out whether it was better to leave the UK pension here or move the UK pension at the point of move to Australia. The tax implications suggest at the minute that you can't, it doesn't really justify moving it from the UK yet, but it might do when the guy retires because it changes the tax situation at retirement.
Right.
So at the minute, we're going to end up remanaging, taking over servicing of the pension, um, which is the L&G one currently. We're going to then structure a tax situation for him to dispose potentially of his ARM shares, which is going to trigger quite heavy capital gains. And then obviously on the back of that, if his capital gains paid, we're looking to try and offset the capital gains by putting some of the funds from that into his pension. And then we've got to, on the back of all that, make sure personal tax returns are dealt with to ensure we claim the tax relief, which I would guess will result in a tax refund.
Right.
Um, but we're going to have to use previous unused tax relief going back 2 years. Yeah, add it all together, and it's like I was saying to you before we started on this podcast. It's quite a complicated scenario for, say, an individual to manage, but for us, if you've done it and you've done it before, it's just a series of admin process, really,
Yeah.
in order of dates, and it's getting all your tax years to line up. Um, and for the client, it's just having the clarity.
Well, it's knowing that those options are available as well, isn't it? It's knowing that you can sort of make use of these planning opportunities, which um, members of the public won't know, will they?
Well, I would say the outcome would have been potentially he would have either kept the US shares, which then obviously sits them in US dollars, and he's then in Australian dollars with a UK sterling based pension. There's a lot of currency going on.
Yeah.
There is an argument for saying as well, if he kept the shares, he then is succumbing at some stage to capital gains in Australia. He could repatriate the cash, but you'd have to pay the capital gains in the UK, repatriate the cash in Australia. You don't get any tax element for moving cash. But then if he kept the shares, moved to Australia as Australian resident, you could end up with Australian version of whatever they pay in capital gains. So it probably makes more sense whilst it's a known quantity and we can get right, pay capital gains, offset capital gains with tax relief, boost your pension. So when you go to Australia, you're going with a boosted UK pension. And then that UK pension without tax penalty based on at the minute when he retires can be then moved to an Australian version, but it's got to be some kind of QROPS that's approved. It's
Yeah.
QROPS structure in Australia. And at that point, we'll probably vet and find him a good Australian advisor that does equivalent to what he's been used to with us for probably the next 10 years.
But it's quite fortunate that he's engaged this at this stage before he retires, so that there are still plenty of options available to him in terms of planning, rather than if he'd have considered this at the point of retirement.
But also, and this triggers a frustration for me, and as you know, I get frustrated by minor things. If we'd have spoken to him 10 years ago and we'd have then assessed the performance potentially of what we do versus what he's got with his Legal and General workplace scheme,
Hmm.
I think he would have benefited from advice regarding the investment side. I think if it'd have been harder, obviously, 10 years ago to do comparisons because we wouldn't have had the 10-year history and therefore the hindsight. But one thing we know is from our pattern, we tend to, and have done for 10 years, push an agenda of take a little bit more risk on movement and go more so into US dominant focus and probably more shares, less bonds. And I think the trouble is a lot of the workplace schemes focus more UK.
Well, I mean, as a general rule, workplace schemes, they are designed to be suitable for everybody, and as a result, they're almost suitable for nobody because they're so broad in their sort of mandate in terms of what they're trying to achieve. They've got to be suitable for someone who's a younger client. They've got to be suitable for someone who's approaching retirement and everybody in between. So it's not it is they try and take a one size fits all approach, which doesn't take into account what a client's plans are.
I think it's a mixture of not taking into account the plans, but also it doesn't then involve a conversation where you say to somebody, look, do you think the UK over the next 10 years, and I'm acting as if it was 10 years ago,
Yeah.
will that outperform some of the up and coming tech companies in the States 10 years ago? And you'd have been looking at really Amazon. Um, Nvidia was nowhere really 10 years ago as a
Yeah.
company, but you'd have Apple, Amazon, Alphabet, or Google as it was then.
Yeah.
Would you have bet against any of those companies with anything in the UK, really, even
No.
10 years ago? Uh, it just didn't, it looked then like we were a little bit behind as a country. And obviously now it's blatant because you've got hindsight.
But it's even simpler than that though, because we sort of weight our portfolios in line with global sort of allocations. So what that means is that our portfolio allocations are in line with the rest of the global market. So if the US is the size the US is, because that's where investors believe the growth opportunity is. And as,
Mm.
at the point where that changes, then the US exposure in our portfolio changes as well.
Yeah. And I think that's the thing. It's the adjustability because we can adjust our portfolio based on how economics are looking. The workplace schemes, don't really adjust. They just the agenda for a lot of workplace schemes was to meet the auto enrollment requirements and then really push money to the UK
But
because UK incentive.
don't forget as well that 10 years ago, most people were buying annuities as well.
Yeah, yeah,
So
yeah.
it wasn't a case of you're going to need your money to grow in retirement. It was a case of we need to get your portfolio or your pension pot to a state where you can then sort of cash it in to buy an annuity, which is what everybody did.
Is it worth just getting the slide up to reiterate what we're saying regarding if 10 years ago we'd have spoken to some of these people?
Yeah, I'll just bring up a quick chart.
I mean, I think there's a few factors, isn't there, on the chart we're about to put on screen. In that,
Can you see that?
yeah. So, I mean, you can talk us through that. I mean, it's if you probably start with like what everything is, just for anybody watching, so they can say,
Yeah. So the red chart, the red sort of line along the bottom is the sort of default fund for the workplace scheme based on the information that we've had previously for our ARM clients. The blue line is our equivalently weighted portfolio. So that's the LiveSmart portfolio that takes the same amount of risk as the Legal and General workplace scheme. And then the black line is our 100%, or sorry, our 97% equity portfolio. So the reason we've included these three lines in the graph, obviously, is to show the difference between having an allocation decided by Legal and General based on their investment mandate to be a default workplace pension and the decisions that they make. So in looking at the portfolio before we came online, Julian, we discussed sort of they're quite underweight to the US, quite overweight to the UK. And these are all decisions that are being made. So it's one of the things when people think, oh, you're slightly overweight to the US. Actually, you're not. You're bang on where sort of the collective wisdom of global investors is. By going underweight to America and overweight to the UK, that's a decision. That's a decision against the collective wisdom of investors. So ultimately, based on, since 2013, that's what's resulted in this gap, is that are those the blue line is the collective wisdom of investors and therefore our portfolios, because that's how we base them. And then the red line is the L&G portfolio based on the decisions that have been made over the past 10 years.
I mean, let's put it into monetary terms for some. So I know some people are funny with percentages. If if today you'd got £300,000 in your pension, and let's say you'd had it in the Legal and General portfolio,
Hmm.
you'd have around about £100,000 more if you'd have been in Portfolio B, which is our equivalent
Yeah.
portfolio. So that's what, an extra 5,000, 6,000 a year in retirement, roughly.
And that's not taking any more risk. That's at the same risk level.
But then I think the interesting thing is if you look at, say, the bit where COVID kicked in around sort of 2020,
Yeah.
you can obviously see the difference in movement between that and then A, which is 100% shares or 97% shares.
Yeah.
And obviously a bigger movement. But then you look at then the gap, the performance gap, even if you go back as far as, say, January 2017, even then it was riding a good 20 to 30% above
Hmm.
the other lines. You think that's when you start to realize when clients talk to us and we say, well, look, are you prepared to accept extra movement for the extra performance? And if they had, the performance differential would have been what? 100 plus percent.
Hmm.
And really, you start to then look at how that translates to retirement, and the figures are just different figures.
Yeah, especially when someone's so far away from retirement where they can't access the pension anyway.
I mean, how many times have we had this conversation with clients and they said, "Oh, but I don't want like that kind of risk." And you're like, "Well, what do you perceive the risk to be?" And all they see is losing all the money.
Well, there's no risk-free scenario. It's a case of which risk are you prepared to take, because ultimately, by taking the safer route and having a less risky or less volatile portfolio when you're accumulating, when you're in your 20s, 30s, 40s, even 50s, the risk you're taking is your retirement pot won't meet the cost of your lifestyle for the rest of your life. That's a risk.
But I think even if you look at it and remove need for now and away from the need part of it, and you just look at it in pure hard pound notes, 500,000, a million. That's basically what it would be.
Mm.
And I think, that's not clever, is it? It's not about being clever. It's not about doing anything complicated or taking, portfolio A, its top holdings, Nvidia, um, Apple, Amazon, Meta,
Yeah.
and then obviously it's got all that exposure plus then obviously what 50-ish% exposure to the US overall, and then spread across globally. You find some of those companies are global anyway, so they already give you global spread.
Yeah.
So when people talk about concentration risk and all that, there's still well, what's not global now that's a large company? It's even Rolls-Royce in the UK is getting pretty much global.
Well, some of these companies operate more so outside, these US-based companies operate more so outside the US than they do in the US.
Yeah, and I think that's the message here. It's just take advice, give us a shout. It's not It's not threatening, is it? It doesn't cost anything for us to give someone that graph, show them what they are versus what they could have been,
Yeah.
give them a bit of a context, start thinking about retirement, start planning ahead, start planning the tax.
It's being intentional, isn't it? It's just thinking about where you're going, engaging with it with everything early, knowing where you're going, and just sort of making sure that everything is sort of aligned to where you're going, rather than not taking any action, because inaction not only makes your choices more difficult later on, but it leaves so much on the table that you won't even realize is on the table.
We've got 250 odd clients. Those 250 odd clients, most of them, a large proportion of them, maybe 80%, are 10 years plus. If they've gained 50 to 100% just on performance, let's forget tax savings, tax advice,
Planning.
helping them out with stuff, claiming tax back, all the little bits that add another 20 to 50%, and then they've gained potentially another, let's be conservative, 35%. Let's go on risk for risk. In
Mm.
this case, what we're talking about, and say 35% gain on performance over 10 years. How much does it equate to in pound notes on some of the clients that we've got now creeping over a million? Would they even have a million?
Mm.
And that's when, people talk about, oh, advisors cost too much. Do we really in that context?
Mm.
Or am I just putting a positive slant on it to sell people the idea of advice?
No, I don't think so.
I mean, that's just talking from example, isn't it? That's actual solid facts, is my point.
Yeah.
If someone felt sold to now, you'd
Mm.
be like, well, let's just talk facts. They're the facts on that graph. They're the facts what we see with our client base.
And that's just investment performance. That's just, as you say, not taking into account all of the other things that we do for clients in terms of managing investor behavior, looking at planning opportunities, tax, all of that sort of thing, intergenerational wealth planning, estate planning. There's so much that goes into it. But as you say, if you just look at this is just a lot of it's intangible and you won't see it until you become a client. But that graph that we've just brought up, you can't argue with that. And that's not to say that it's just a case of thinking. It's just a case of engaging and thinking about where you want to be and then working backwards and having a bit of a plan to get there.
I mean, let's talk about the other client. So, client number two is in a situation where he's gone through a bit of a divorce, um, is therefore mortgaged up a lot heftier than he would have been. He's dropped his sort of general budget, I would say, to the point where every month he's sort of fighting, even though obviously his pay package via ARM is good. Um, Obviously, a proportion of it is paid in shares. So what was going to happen? He was going to sell the shares, potentially pay capital gains, and repay it off his mortgage. he's at pension age, so he can draw his pension. So I've said, well, do we consider putting the shares into your private pension, which we've already got some of his pension, and then obviously he's got some pension that's built up with ARM, but he's not long-term ARM staff, so he's not got loads in other stuff. Soon, obviously, the legal and general stuff gets looked at because, well, you've seen the performance differential. There's an argument there. But what we're looking to do is basically use his tax band. So his tax bands is into 50% potentially, and put the proceeds from the shares in his pension. He's then got some few other bits going off where we could potentially top that up a little bit more, maximize his pension as much as we can, and then draw his tax-free cash. And what it actually means is then it frees up money to potentially pay such a large chunk off his mortgage from a mixture of the growth he's had with us probably for 2 to 3 years, which has been good. Because again, we've pushed him up a little bit on shares and it's really paid off. Even allowing for what's happened with Trump, it's still paid off.
Mm.
Because over a year, it's still 12 to 15% up, even if you take the last year. Now then, the tax relief, in his case, it's freeing up some to 20% to claim back via his tax return, and 20% goes straight in his pension. So it's instantly enhanced, it instantly coming back out. You compare that to just paying the money off simple after capital gains. How much does he actually gain in percentage terms? Extra money to pay off his mortgage.
Mm.
He's obviously got the 20% enhancement versus a 20% payout.
Yeah.
And his tax return allows him to free up some money net, so his net income increases, which gives him money to overpay, albeit only potentially one more year after.
Yeah.
And I think it will sort of change his life a little bit because it suddenly means he can afford his outgoings. So then we can start looking at proper planning where we say, right, well, now we can juggle between overpayments, or do we go tax relief and use the tax relief saving by putting extra money in your pension towards.
Yeah. You go from survival into sort of planning, what does the future look like mode. But on capital gains though, it's a big thing. I mean, the capital gains annual exempt amount has reduced in successive years from £12,000 to £6,000. It's now at £3,000. So the planning opportunities to manage capital gains are a lot slimmer than they used to be. So
it's near impossible. Yeah,
so the earlier you sort of look at, if you've got shares, unwrapped investments, whether that's share save, anything like that, the earlier you look at sort of, even if you want to keep the shares, but the earlier you look at maybe moving those shares into an ISA where the growth is then inside a tax efficient wrapper, the better you can manage those gains and the less tax you'll ultimately pay. Because again, it's a thing where if you just have those shares and you never really look at them, by the time you want to come to sell them, the amount of money that you'll pay in tax if you want to sell them all in one go versus if you every year you'd sort of chipped away at it with whether you put some money into your pension and the tax relief offsets that, or whether you utilize your annual exempt amounts each year, then you start to sort of make it slightly more efficient than it would otherwise be.
Well, again, it's something we've touched on before. It's not always about just pure get this, get that, claim that back. It's not so much about just the numbers.
Mm.
It's almost a bit beyond that, and it's more about accountability. And obviously, once we get a client triggered into something like this, obviously then we're managing bits to then encourage them to, right, well, why don't you sell some shares this year? And if you just use your £3,000 allowance, it's only £3,000, but it still thins it out, less gains in the future.
Yeah.
Let's not forget, and we've not really touched on it yet, if somebody's really precious about keeping ARM shares, which some people are, because let's face it, it's sort of going places, it's AI.
Mm.
Yeah, I don't know what it's done in a year, but I'm guessing it's still 50-60% up in 1 year. So people don't always want to sell the shares, invest in what we normally would say put in, which obviously was on that graph. Actually, what they want to do is rebuy the shares, which we can do.
Mm.
But any future capital gains are gone, aren't they?
Yeah.
So you look at it, even if you didn't do some of the other bits, like, oh, take that out to pay the mortgage off. And, even if it wasn't really about so much just the tax element now and getting tax relief, you're still saving tax moving forwards, which is taking 20-ish% off any future gains.
Well, exactly.
Why hamper yourself?
The earlier you do it, the earlier you move those shares into a tax efficient wrapper, the more growth will be inside that wrapper, and ultimately the less will be harvested by capital gains.
Yeah.
But just
So
on that, actually, there's another thing to consider there, and it's not necessarily there's no right or wrong answer to this, but it's just something I think people ought to consider, is that even if the share's doing really well at the moment, if you have the majority of your investable wealth in the share in the company shares that you also work for, when people talk about diversification, if anything happens to that company, not only is your job potentially at risk, but also your your savings, your portfolio. So there isn't, I think it's worth having a conversation about diversification.
yeah, I mean, I think it's like everything, isn't it? Like something like ARM shares as the example, they've done really well. I'm just trying to look at some figures now as I'm talking as to how well they've done. So we've got some again, as you know, I like a bit of context. So now this is what you're saying, really. So if you look over 3 months, they're 27.18% down.
Mm,
Now that's because of the Trump tariff scenario, and obviously anything semiconductor related has been hit quite hard because of the Chinese tariffs. Because a lot of stuff goes to China because they obviously eat up tech and chips and all the rest of it, and it all leans towards the AI they're trying to put in because even their supposedly better version of ChatGPT was powered by old NVIDIA chips, ultimately architecture done by ARM. So it's all connected. So it's down. It's been hit quite hard. Now, obviously, if you've got 150 grand in ARM and you've lost nearly 30%, bear in mind it's probably improved because it started to pick back up over 3 months. You compare that to something similar to our portfolio. Um, so Vanguard Life Strategy 100, that's 7.22% down. So the ironic thing is people don't take enough risk with their pension portfolio and they put it into multi-asset three, but then they've got 150 grand's worth of ARM shares that they don't mind losing 30% on because they work there.
and it's one share.
And it's one share failure. But then you start questioning, don't you? Like if you're tracking indexes, you don't, if you get full failure, it might be one of the smaller shares at the very edge of, or you get a company that doesn't do very well, so it gets bought out for like a knockdown share price, so the share price plummets.
Yeah.
You don't very often get full failure,
No.
and if you do, it's like not noticeable because it's like, when you look at the money in it versus say someone in, I've got 150 grand in there, and it's nothing like those kind of numbers.
Yeah.
It could be like £20. So I don't think clients always understand that risk.
Mm.
And it's proven, isn't it? Because the client in question has got 8% exposure to the US in his pension, and then he's got 100% exposure in his shares with ARM.
Yeah.
Yeah, it doesn't, the risk doesn't compute. Do you know what I mean? They don't think of it like that.
Yeah.
And I think when we start making them more accountable for the thought processes, and even just, well, do you want us to rebuy the ARM shares based on, say, that conversation? Some will say, well, maybe just buy 20 grand's worth back rather than
Mm.
70, because you've suddenly like made them realize the implications.
Yeah.
And I think, again, do people need advice?
Always.
They don't realize it though, do they? They don't know. They don't know that they need it. They don't know what they don't know. They don't know what we know. And I think that's the benefit of being able to do stuff like this. It shows why someone might want to give us a shout
Yeah.
and just run something through.
Yeah.
Doesn't cost anything, does it, to run something through?
No.
Um, so client number 3 example. This is a bit less intricate in that getting closer to retirement, probably a year or two off at the most. We've got him up over a period of time to the right levels of security to start to consider it. He's So he's got a scenario where it's more about maximizing tax relief because he's coming up to retirement. So in his case, it's right. Well, do you keep your ARM shares and keep incurring or accruing more capital gains? Do we use tax relief? Because obviously it saves him 40 odd percent on everything that then he sells in his shares, moves to his pension, ready for retirement. So it's not only enhancing his retirement pot, it's offsetting capital gains. Um, it's one of those where you think, well, how many people now? Probably typically it's I would say your ex contractors, which have then got employed because of IR 45, where they've just gone, right, can't do contracting anymore, get a job. They've got a job at ARM because of their knowledge writing code and dealing with software scenarios. And then now they're in a situation where they've got a lot more tax planning because they've not got a limited company anymore. They're now employed. They're then getting shares as part of the wage package. Which, to be fair, this is now becoming a trend as well. There's a lot of it's happening quite a lot in pharmaceuticals. They need advice. Otherwise, basically, it will cost them 20% of 70 grand here and there, losing 40% here and there on 70 grand. And, that's just 1 year.
Mm.
Imagine 10 years worth of this.
Well, the amount of people that are just sort of creeping up to, they're in that just over £100,000 bracket where
So,
you get hammered on tax if you're in that sort of marginal area.
Well, I was saying to you, I've never known a year where I've had so many people contact me that are earning more than 100k, so they've got the 100k threshold tax problem. And I think anyone looking in that doesn't earn 100k might not be able to relate because obviously you can only relate to where you're at and where you work and who's around you. And then you tend to find that when someone works, say, there, if the average wage is 60, they can only relate to other people earning 60 to 80. When you're sort of in the 100k plus club, you tend to then work with quite a few people that earn 100k plus. So you're in a different sort of club, aren't you?
Mm.
Um, I've never had so many people under the age of about 40, 45, which are 100k plus, contacting me. I've never had the volume of contact because of that specific,
Mm.
and it's been pretty much around February this year. So I don't know if that's because it's coming up to the end of the tax year or
Well, you think about what wage inflation has looked like over the recently, and tax brackets have stayed the same. So ultimately, you're always going to have people who are nudging up, nudging up, nudging up, and then more people break through that barrier, and they
I
have
mean,
different problems to think about at that
I
level.
mean, for us as a business, it's becoming a niche because if you think about it, we've now got a lot of the research facilities, the data. When you start to know like what the pension scheme looks like, we can efficiently deal with any client in this scenario working for certain companies. And it's not the same as starting from scratch, is it? We've done probably 80% of the work already.
Yeah.
And it allows us to be quite a lot more efficient on what we charge someone because we don't have to start from scratch. So it makes us more effective.
Mm.
It's not new information. Um, I think the underlying sort of the undertone of this podcast really is just give us a ring.